I'm going to tell you a bit about me and about business, but really going to focus on the sort of presentation. We do these workshops at accelerators, universities, with banks, with law firms, so clients, and other places that we've developed. And we actually developed this originally for Cambridge University, so business presentation for today. And hopefully be helpful and useful to you in terms of context about raising money, what's out there. This one's also great to be back here, because I've been back here for a year, and we were based here during the pandemic, came here by chance and stayed and loved it, and come back on some boards whenever we can, but I've been back for a year. And when I was here, really enjoyed the connections and the camaraderie of Ignite, Sean and other folks. Nice to work out of here and stuff, and be back a little bit more often now, just time flies by. And it's great to sort of help and work with entrepreneurs. I think one of the things is that a lot of the stuff we do is working with venture capital firms and private firms, a little bit beyond in terms of the funding styles, beyond a lot of the local stuff here. But obviously, if you want your business to move beyond, this is kind of the kind of area of trying to think about how to interact with. And I can talk to you about other areas of fundraising, because some of the stuff we've seen here relates to whether you're what's an early stage business or late stage business. Now, also I mentioned that happy to do this like a workshop. I want to try and get through the slides if possible without saying too long. I was watching a video somewhere, somebody sent me a video yesterday of a speech or something made about something in Bermuda, where a speaker said he'd speak for 10 minutes every letter of the university he went to, Yale, so it's only like 40 minutes, but then he used to MIT, Massachusetts Institute of Technology, that might go on for hours. So going on for hours today. But if we can cover the slides and if there are questions that come in throughout, that'd be great. But what I was going to say is the best question today was going to get a bottle of champagne, quasi champagne, for Christmas. So I've got a little gift there for the best question today. So the odds pretty good. And Sean is ruled out now. Sean, you're too tainted. So this was the best question we have. So I'm going to launch into this. This is a bit about me. There's always a problem when it comes to showing the video. Later, we'll come to that in a minute. I've got some cards here to hand out anyway. These are kind of the sort of flyers, what we do. So if you can hand those out amongst yourselves while I'm doing this. And I tend to like to walk myself through on some slides here. I tend to look backwards all the time, but if you can see this, and we'll run through this. So I'm the co-founder or the founder's business of Qodeo. It's pronounced like Qodeo with a Q. We had to make up a name. We started the business because so many names were putting names together, LinkedIn, Facebook, all that kind of stuff at the time. We wanted to have something a bit different. And it came from the idea of what's called quotes and ideation. Ideation is about creation of ideas and business and stuff. What we do as a business is we have a platform that matches, and I'll explain how it works. We're interested about over 7,000 venture capital and private equity firms globally with entrepreneurs, diverse entrepreneurs. One of the fascinating things we found is that underserved entrepreneurs are actually the best opportunities in many cases for venture capital and private equity firms, because venture or VCs, people often like to do deals with who they know. But you'll see later they get lower returns, they get lower results by investing in people they know. But actually, if they look more broadly, they get better returns, and it's actually all kind of benefits diversity. And we find that actually a lot of the people who come to the platform and be most successful have actually come from either regional or diverse background interactions, because as a platform, if you can see who's who in the zoo, effectively who the venture firms might be to back your business, you are, it's agnostic effectively. So it's all trying through algorithms, we're trying to sort who the best matches might be. It's a bit like dating in a sense. So you put a bit of information system and it will spit out who the ranked matches, best matches would be for your funding opportunity. Now, having said that, venture and private is not easy money to get. So it's a bit like dating, since you meet lots of people, kiss lots of frogs, we call it. You'll see that.
And I have a fear of frogs on here, looking at that picture.
Oh, sorry.
I have a phobia.
Phobia of frogs. Oh dear.
Yes.
We'll try and skip along as quickly as possible. Maybe that's not too unfortunate. But I won't croak too much today. But it's a kissing frogs analogy though, in terms of you have to, when you're dating is remarkably similar to raising money. And I used to say, dating is like it's like raising money, and then except raising money, raising funding for an entrepreneurial business is for money, whereas dating isn't. But actually, finding in reality, dating is much more about money than raising money for a venture is.
Dating can be about money.
Yeah, exactly. So we found research, average British marriage lasts less long than the average ventured entrepreneur relationship. Okay. And there are a lot of similarities because you have to get on with the people you're working across the table, or financial discussions, other stuff like that people have in relationships as well. So it's actually remarkably analogous. I need to meet lots and lots of folks, but obviously you want to meet fewer people. You want to focus you're going to meet, and then you only end up with working with one or two in the end. And that's amazing. It's like a funnel down. It's very similar to dating analogy. Let's just end up with multiple wives. There are a few people we dealt with in the Middle East who have multiple wives, but generally people don't have multiple wives or partners or husbands, or it might be, but you end up with one or two, hopefully over life's trajectory, and very similar with funding. In many cases, you only end up with very few out of 40 people. You want to try and focus who you're going to try and talk to. And what we do effectively is, by both the algorithms we built and data we built, is identify, based on your information, who the best matches might be for you. But that doesn't guarantee results. Like dating on an app or something, you may find the people you meet with aren't actually what they seem, or they don't get on the time, or it's not the right time for them, or a lot of this is about timing, very similar to dating as well. I sort of Sean before about the market globally for venture capital at the moment. It's a bit complicated at the moment, and that it often is about the time when you interact. Has this venture firm got money available now because they just raised their own money? They, like you, raise their own money, so have they got their own money to deploy? If it's the wrong time, somebody's married, presume you shouldn't be running off with them. And similarly, the venture capital firm, if they're going to invest in someone like you, they may not put money into your business at the moment because it might not be the right time. So it's not even the right business. It can be timing, all kind of stuff like that. So lots of analogies. But so we moved from being just a pure database as a business to actually having a matching capability, because most entrepreneurs use databases to try and find out who might fund them, but they don't understand what they're looking for, and they waste a lot of time trying to do that. So we try to curate that to an extent. Not perfectly. We're getting better at that in various ways. And then we have venture capital firms and priority firms who fund entrepreneurs who come in to look at entrepreneurial opportunities in the flip side of it. My background is I've worked for a couple of venture firms in the UK. I've worked in advisory, worked at EY, worked in banking, lots of different kind of roles in different places. I've worked in Australasia, I've worked in the US. I'm currently mainly based now, worked in the UK, obviously. And I've worked around venture in all kinds of ways. I've had a couple of businesses of various sorts, including this one, but I had previous businesses. And also worked trying to help people raise money or be looking at opportunities. So this idea for this business came up when I was actually working with a venture firm, looking at how we actually identify who to back. And there were no systems really helping us to do that. So the flip side of you looking for money is those looking to spend the money and how they could actually do that. And I've spoken lots of different places with the FT and other bits and things like that.
You get into the matching capability in a minute.
I can talk more about that if you like, but this is mainly about this is about really what you should think about as an entrepreneur, which is kind of how we built the algorithms to a great extent. So we put together, sort of the best question here, because first question, so you should try to do this first and only question. So we basically looked at how venture capital firms, private firms deploy cash and what they were looking for. And we found that most VCs were using data to try and find opportunity-wise. They actually wanted matches. So we built algorithms to kind of look at the factors that are relevant to them. And then if the entrepreneur puts information on the other side, it automatically calibrates it against some scores and ranks against that. And you get like a series of hot, warm, and cool matches, depending on who your business might be. There's no guarantee that you're going to be able to connect with those folks because they're not easy to connect with. There's multiple techniques we now suggest people use to reach out to those people. And there's no guarantee you did get the transaction done. We don't do the transactions. We're not a kind of crowdfund, so we don't manage money. We have people who have money on the platform looking for opportunities. People are looking for money on the other side, but it's like the matching analogy makes no sense in terms of how it works. What I'll do though today is go through the kind of the kind of, it relates a lot to how we built the algorithms because it's a lot of anti-intuitives in how you raise money. So one of the things I hope for you to take away today is that what you might think is obvious, someone's asking someone to put money into your business, is not quite what they perceive on the other side. And it's like men and women always like, get relationships. Also, people misunderstand each other in lots of ways. It's like that. People sort of say similar language, but actually mean completely different things. And how to understand. So on the one hand, we want to make your journey, try and identify who to speak to as simple as possible. We can make sure you don't have to learn the whole story for how a venture works. But by the same token, it's useful to understand the background at least, and how you position and jockey yourselves around. So we have these different entrepreneur types of profiles and system, and what's called concierge. So Sean put some entrepreneurs through the concierge program last year. We're trying to do this again this year. We give feedback. That's increasingly becoming automated through AI and other kind of ways to give feedback back to people now. But we do them still manually as well through workshops, individually giving feedback to entrepreneurs about their profiles. And you build a profile on our platform. And we realized in the last year or so that what happened is that when people build their profiles, they, some questions are intimidating, some people don't. Strangely, our CTO changed Chief Technology Officer this year, and he's doing all kind of stuff to enhance and change the user interface of platforms and the language of the platform. But he worked at eHarmony previously, the dating platform, which is incredibly relevant. And he said one of the things that eHarmony that they found difficult was how to extract personal information from people, because their system is more complex than some of the other dating apps. It's supposedly more successful in how you gauge success. And apparently extracting information about people's personal likes, dislikes, or kind of the trait kind of information. They like sharing such kind of stuff on dating apps. They share that certain things. And similarly with this kind of stuff, getting people to actually share information or understand how to share and what to share is difficult. But then even if you put the information in, sometimes people kind of get it. You've got to have an honest profile to do the matching, otherwise there's no point getting in there. It's like dating something years ago, someone picks me up with somebody, 6 weeks ago, they look completely different. They work with people different to what I imagine. You kind of feel like missold effectively. And that's the same on these kind of things. You have to have an accurate profile to kind of try and do a match. But by the same token, you want to put the best foot forward because competitive kind of things like dating, thousands of profiles out there. There's thousands of profiles VCs, venture capital and private equity firms are looking at all the time. And it's how do you stand out and how do you look like they assume you should look within reason. So there's kind of like, if you look too out of line, too unusual, sometimes that can be good because sometimes there's a reason why that is. But sometimes, so in fact, when I was in venture capital years ago, the firm I worked for, when I was there, we backed Arm Holdings, which is an enormous success story, recently IPO'd in New York for like $50-something billion. But when we backed, we were the first investor, Amadeus Capital Partners.
Which company?
Arm Holdings. Arm Holdings designs the chips in mobile phones and iPads, that kind of stuff.
ARM, right?
Yeah, ARM, but with Arm Holdings. So a guy called Robin Saxby, that sort of up in Cambridge, UK. We were Cambridge-based, UK-based VC. And they had this idea they're going to design chips rather than manufacture them. At the time, it was the late 90s, early 2000s, everybody manufactured chips. Like Intel was the big thing. Sort of changes in these huge companies. And it didn't kind of fall entirely in that criteria because people were just looking at making chips. And they thought you'd make and design at the same time. Arm's model, there's no we design chips. Therefore, don't have to get involved with manufacturing stuff. That's commodified. Anybody, not anybody can make chips. Clean factories and kind of stuff, but manufacturing is relatively commodified. Is the design of California. I looked at the back of my iPhone there, it says designed in California, manufactured in China. So the design is what Apple does, not the manufacture. In the old days, you saw Apple was manufactured by Apple in California, no longer. And similarly, with Arm Holdings saw that you could actually design and not manufacture, but that was outside some of the criteria we had. So we almost didn't do the deal, but that was become one of the most successful businesses. I mean, SoftBank bought them, they was listed in New York at $50-something billion, been up and down a bit, but it's a startup business 25 years ago. So, but didn't fully fit criteria. So sometimes if a VC looks at something, they don't quite look like what they expect. That can be good, but you want to kind of put your best foot forward. So what we do is we review people's profiles and say, well, actually, yes, you want to be honest, and it may be you never get close, but it may be that maybe somebody picks you up at a different point, maybe a new fund gets created, maybe you're not not the trendiest thing now, it might be a few months' time as a new fund emerges, etc. But try and put your best foot forward and try and show you how to do that. And I'm going to go through 11 myths today that relate to how we built the platform itself, but without giving away too much intellectual property. But some of this is obvious to you, some is not obvious, and some people this is helpful. So we focus on venture capital, private equity. We will move, which are the big firms, right? They raise lots of money from pension funds, as kind of folks. and invest into early stage growing businesses. Is everybody aware of what VCs do, or it's fine if you don't? So it's a venture capital firms basically raise money from your pensions, other things. They manage that money. They take various commissions in various ways to do that. They're a commission business effectively. They then choose to invest in various businesses. They take equity stakes in those various businesses usually, and advise and help grow those businesses to then sell them in a few years' time in some form or other and get a return. I certainly hope if you invest now at $1 million valuation, it'll be worth 10 million in 5 years' time or something. And they get their money from when they exit and sell the business. They also get some other money, but their main compensation is for selling the business. They're always looking, the mindset is always, they're getting into your business to sell it in a few years' time. They're not interested in holding. I mean, they hold for long term, to ensure that also. So they hold for longer than they expect in a business. They'll be in a business for longer than they expect. But at the end of the day, they get their money and their investors' money back when they sell the stakes they've taken as businesses. A lot of people here will be familiar with business angels. So we don't deal so much with angels. We're looking at it. We kind of constantly look at whether we add that functionality. Question asked about it all the time. We might do it next year or so. Angels who are like individual people who put money into earlier stage businesses. There's a lot more activity like that here on the island for building moving. Can work individually, can work in groups, can be on platforms. You can meet them in just by happenstance in various different ways. They are individuals and they operate differently because obviously it's their own money. So it's your own money, you think differently about it than somebody else's money you're managing. And so angels are a much more random bunch of folks because what expertise they bring, whether they're going to, whether chemistry will be there is much more important. You know, do they have an angle because they've got some distribution platform they can help with that kind of stuff. They're much more like that in how they think. But because of their own money, they tend to put in small amounts of money. But earlier stage businesses, newer businesses have yet to grow. And they're just slightly kind of motivations. At the end of the day, they also want to sell those stakes, those businesses. That's how they get their returns also. So it's relatively similar, just at smaller initial amounts of money. Venture capital firms tend to start at anywhere in investors of $250,000, $500,000 upwards, what's called seed, sometimes pre-seed, some of these different stages and how much of this stuff you've gone through before, all the way up to billions. I met last week, I was saying, Sean, a guy called David Rubenstein, last week, the founder of Carlyle. Carlyle's like hundreds of billions of dollars, global building airports and also tech businesses, all kind of stuff. Huge private equity firm, it's called. So there can be those kind of businesses that do stuff, but they operate relatively similarly in a funny way philosophically to early stage. Every VC, every venture capital firm, private firm defines what areas they invest into, so where they invest geographically, where they invest by sector, where they invest by stage of business. So is your business profitable or not? That may be one of the criteria. Is it technology? What kind of technology is it? You know, they're quite specific sometimes, some are broader. So there's a whole sort of range there. Anyway, sorry.
Can I ask before you go on? So back to the entrepreneur compatibility.
Yeah.
So what about like value comparisons when you're, because you mentioned that we're all funneling kind of through and to find like the right match, and you'll kind of compare the venture capitalist with like the entrepreneur. What about like values? Like, is that something taken into consideration? So for instance, like if a business is like a for-profit business, but it has a charitable component, and it realizes, like the business owner realizes that it's going to be sold off at some point, how is the deal done in like an instance like that where you want to maintain like the philanthropic like component of the business?
Right.
Like, is that something that would be taken into consideration when you're finding how compatible?
If you're getting money for a venture capitalist, one of the big questions we often have entrepreneurs say, well, let me give me some money. Giving is donations and charity, whereas investing is for return.
It's completely different.
So invariably, investors are looking for return. So they're not interested in they're not interested in the charitable aims of something, but they want to put money in to get a financial return. So they're looking for for-profit businesses. There are a lot of circumstances where for-profit businesses have a social aim of some sort.
Yes, like this.
So there's impact investing. It's called a very big thing these days. There's sustainability, there's environmental issues. We've just implemented something in our system. It's called diversity fields on our system. So that if you're a diverse, it's been testing last few weeks. If you're a diverse entrepreneur looking to raise funds from diversity-focused funders,
Yeah.
investors, it fast tracks you on that process and helps identify that for both sides.
Okay,
There's a lot of demand for that, last year or so.
yeah,
That's kind of social impact thing.
yes,
The other side is that if your business, some people will want their business to be partly owned by a charity.
no,
So, okay, because you can give your shares
okay,
to a charitable entity, then it's a
yes,
shareholder, then the issue is
Okay.
going to be for the investor, how does that shareholder behave
yeah,
alongside me as another shareholder,
Uh-huh.
because they might have different governance or motivations, etc.
yeah,
But that's a bit more neutral than, I mean, the whole open AI thing, apparently one of the big parts of the whole kind of blow up the other week was apparently there's some charitable part of what Sam Altman's trying to do at OpenAI, and there's a business part of it. There's a lot of confusion about some of the social aims of it and also social issues around impact. So that was part of one of the problems that apparently occurred in that business. That's split that the other week and then
Yes.
rejoined. So but generally a venture firm, a private equity firm, an angel investor will want to get a return. And so they won't. So you've got to have your structure clean.
yes,
So even if there's some kind, even if you say that we give 10% to charity or something,
Mhm.
because that's one of our motivations, part of our USP, that's cool if they know that, and that's one that they want to buy into. That's to be very clear.
uh-huh,
But if there's some sort of funny sort of structure between it being a charity being for profit, they probably turn away from it because they need it to be a for profit entity.
yes, so it would be more desirable to have like a for-profit entity with a clear, structured, social,
Yeah.
like,
If you've got a social aim as a
Yeah.
for-profit business and you want to give some of the profits or some of the shareholding, where it
Yeah.
might be, to charity, there's a group in American France called now where they encourage, I think Warren Buffett joined it and Bill Gates, they encourage entrepreneurs, some big ones, but to put money into, let's put some of their shares into
Giving
charity.
pledge.
Yeah.
yeah,
There's all this kind of stuff out there. There's lots of different kind of things like that, where but there's also more generic things of, we believe this business is both ESG is social, environmental type
Yeah.
investing is meant to both, and this question about whether it would achieve this was meant to both get a return for the investors and help the environment. So you can have sort of the dual thing, but at the end of the day, a lot of the confusion and frustration around this kind of areas is, are they going to get returns? Because if they don't get returns, but they help the environment, are they really going to help their environment long term? Because if they're not going to get more money invested into later kind of stuff, there's a lot of kind of wait to be seen, jury's out kind of stuff.
thank you.
That's right. So I'm going to go through these 11 myths, trying to help you think that when you're talking to an investor, whether they be an angel or a VC, but obviously we're more VC focused, but they're very similar kind of things. What are they looking for when they look at them as a potential target to be invested into? So so whilst we try to automate who you should speak to, and we try and say to you, you shouldn't have to learn the game of VC too much, because we'll take over some of that by sorting who those matches might be. Should you then be able to get through to those VCs? It's not always easy to get through to these VCs. Various techniques to do that through us, but also other mechanisms also. You then need to know kind of who you talk to, and also when you're building a profile, how you build a profile in our system helps to think about some of this kind of stuff. So most people, most entrepreneurs think that VCs, because they're interested in financial returns, look at financial stuff first, the most important thing. Actually, what venture capitalists should look at the most is people. So the number one criterion in success in a business is people. Now, there's some people who are like great at building early stage business and bail out, either because they fall out, like the founder of Uber and stuff, like Travis went crazy. Sam Altman had this kind of blowout the other week with OpenAI. You often have this entrepreneurs. They're very inspirational. They're very good at building something, or some of these toxic types who build these amazing fast growth business when actually it has to be bigger. And has to be more professionalized, they can't handle it. Sometimes they can. People like Branson have managed all kinds of scales of businesses. But the number one thing you think about, because when you particularly earlier stage you go, and obviously most businesses here will be earlier stage, and newer businesses very much identify with you as the entrepreneur effectively. They're backing you. So one of the things we say here, in fact, one of the things that Alan, our CTO, is very useful to work for HR platform, they're matching also. So if you look for a job, things like Indeed and stuff, effectively doing quite similar kind of thing anyway. They're matching in one way or another. And what's important in getting a job, or what's important in getting money raised, is not just what you've done. Because lots of people might say, oh, I haven't done certain things, so are they going to back me? So it's important to say what is in your resume. Actually, it's more important to say what is on your resume, how it maps across, how it's relevant to what you're trying to build. So why is it that you have the skills and the knowledge and the insight to build something? Some people come from industries to build something. I worked in venture with some colleagues, ended up doing this because it kind of related to the experience when we saw the opportunity through what we've done. But some people have completely new ideas. They got, I mean, it's actually interesting. There's some people that's incredibly successful where people have no background, so they started off and very successful. But a lot of businesses tend to come out of something you've done. You know, you work with an insurance company here in Bermuda, so you start an insurtech company. We know people here who've done that, who, you know, have people on the platform who've like had insurance-related business because they're in Bermuda, because insurance is big in Bermuda, reinsurance, whatever it is, and they have ideas. They've worked there, and they want to spin out and do something different, banking or you know, certain kind of. Often there's a connection, or sometimes there's some more random. But the important thing is that think about who are the people behind the business and what do they lend to the business. Why them? Why you? And that's again a bit like dating sense. So this is some this is the slide, the part left-hand part of the slide is from some research we did. We work with lots of business schools around the world on research, and the Boston University team interviewed venture capital firms in the Boston area, from the kind of key market. Boston's interesting actually from this perspective, because when entrepreneurs try to start to raise money in the venture private space from Bermuda, you can kind of look towards London in certain things, because there's obviously connections from the UK, and definitely insurance industry, a lot of connections back to UK. But many businesses will look towards the US to raise money if they're going to go to the venture stage. And Boston actually is quite an active market, which has various connections backwards and forwards here. So this is actually a survey from Boston VCs. And we have a number of Boston, we're tracking some 7,000 VCs on the platform. We've interviewed over 1,000 in person, many of whom are from, I think 30 or 40 are from the Boston area, for instance. And we interviewed and said, what with this team, said, what's important? And although it's roughly a third, said team is number one criterion, obviously other things as well, that's a standout. So team is always the most important. As you grow a later stage business, your business is already established, you've got like a retail business already established, or it might be whatever it might be, that's more established, people are less concerned by team, but it's always important. If something goes wrong at the head of a company, it can blow up a company. So team is always, team or the people are the most important question. You're after booze, aren't you?
I don't know. I must have missed the rules of the meeting. So no questions till later.
No. I'm happy to take questions. So the best question wins the booze. So,
Oh, I didn't know that.
You missed that.
I'm glad I understand now.
That GPT working?
Yeah. So it strikes me that I've been involved with some companies that have pitched VCs. It's extremely frustrating situation. It's very common. You can go to 100 VCs and go 0 for 100. So it's great to know about your platform, because I'm sure that increases your odds of a match. But at the end of the day, the team thing, I think you're spot on. That's what we found. And literally one company I worked for 3 years for Sweat Equity, extremely talented people, brilliant idea to modernize the fixed income market. But we could never get big funding. And I found out after I left that it was because the CEO who did all the pitching, they didn't believe he was an expert and passionate, but he had never brought a company, he had never had a successful exit from a company. So they're like, I'm only going to put in a $250,000 check. I'm not going to invest. So as we went to Series A, after that, that was the deal breaker. So how do you reconcile that? I assume people in this room, most of them probably haven't exited successfully a company. So what's your advice in the VC community for how to overcome that when team is so important?
So team is more about what you're doing to run the business. So that may be a criteria. So some VCs say you have to exit or run or raise money before or something. So actually one of the criteria is that on the system. So we ask the VCs that question: would you back VCs who haven't exited, haven't raised VC money before? Is a question. Now, quite common in Silicon Valley, they expect that, or they want that, because there's a whole community going on there. Of course, with the best returns in Silicon Valley, people have never raised money before. Zuckerberg never raised money before. We're doing one of there's a VC fund that's co-founded by one of Zuckerberg's co-founders. He fell out with. If you watch the movie in Social Network, Eduardo Severin, one of his colleagues in Singapore a few weeks ago. Who's the guy, one of the two sets who fell out with him, one he was a Brazilian entrepreneur now who runs a VC firm, and these Winklevoss twins, I also met a very bizarre pair, but they're identical twins, like 10 foot tall rowers, ex-Harvard and stuff, but they went to do crypto in the end. But so he'd have raised money, Sergey Brin at Google had raised money before, you don't have to let's raise money to get great returns, but some VCs want that as a criterion. That is a criterion. So that's a criterion. We will steer you, maybe not to them, but less to them. I mean, something how the algorithms work. We're constantly changing algorithms work, but do you have pass go factors, or do you have more rubbery kind of factors? We've got more the rubbery kind of way, so more of a kind of a gradated kind of scale of possible match as opposed to no. Because sometimes people change, like they're saying that Arm Holdings experience, they didn't fit the criteria for us ways, and we would have, if you'd been too binary about it, would have rejected it and never backed them. They would never probably come what they've become. We certainly never got the return that firm got from them. So it's always a bit of a funny thing. Do you kind of just like have a pass go kind of question or not? But the idea is to try and filter and try to focus. It's not going to be successful, but it might be, for instance, if the business is trying to go Silicon Valley VCs and hasn't got people who have sold business before, that's probably the wrong approach. So even if some of the matches might come up there on greater sort of review, one might recommend we'll actually go to firms in Boston or something where there's various criteria they may have, but where they may not be looking for people, may not be expecting people to come in the door who raise money for. That's not the most important criteria in those cases. What most VCs will do is help you exit. But a lot of them have like bankers and consultants in their teams anyway who will help you do the exit, help you sell the business. So it's kind of funny one to be so fixated on, but it can be. But team is number one. In earlier stage business, it's often thought of as it depends if you're a technology business or not, but technology, obviously if you're a technology business, technology is important, but you can always pivot or change. It's a bit of a funny one, sort of double-edged sword always in terms of that criterion, because one of the difficulties is always chicken egg. Sean and I were talking about this before. How much have you built? People always want something to build, but then how are you going to build it? You've got to afford it in the first place. So how can you get there? That's kind of where angels come in. That if you're trying to build something, test something, angels in small amounts of money can help you test like a beta, like a test hub of something, to be able to demonstrate something. One of the things that's happened with VCs more recently, there's a bit of an economic downturn globally at the moment, is that people have become more, VCs become a bit more demanding because of how advanced your business is by the time they look at it. That's a mistake in many cases because you have to get in earlier to get a return. If you wait for things to be fully baked, that may not be the right way to do it, unless that's your criteria in the first place. It's people moving the goalposts a bit. But if everyone moves the goalposts up towards an already built business, then the question is what they're getting in for. Why would you want them? So is what you often have to say. Somebody turns around to you in a meeting, and a VC or an investor says they want it further along. Try to agree what that milestone might be. Maybe they can help you to reach that milestone. Maybe if you're going to put in, talk to an angel, say you want $50,000 to build this part of the business, well, why put 10,000 now, or sort of step it. Now you can also screw yourself by doing this. If you don't get where you want to get, they're going to put the rest in. But maybe the way is to break it down. So, well, let me sort of hit this milestone if I build this particular thing. But people want to see in technology businesses what you built, how you built it, and is it intellectual property around it? In case is the code yours? Very important in technology businesses if you own the code. Very important for all entrepreneurial businesses, all venture capital firms. Make sure that it's very clear. Goes back to the charity question before. Your entity owns everything. I remember I was a mentor actually to somebody here the other year, a lovely entrepreneur, and the details of the business. It's such a small place. You be careful to say that, but lovely person. But there was kind of confused ownership structure of her business. Ownership would be who owned her business, and who owned effectively the trade of her business. Who owned the branding and stuff. You've got to get all that kind of stuff sorted before you go out to venture firms. That's a related actually technology question. Technology and intellectual property kind of related issues. Absolutely make sure that's all very clean. You know who owns what. Also, so you have multiple founders going up the team stuff. Do the team members add complementary skills to each other if you've got more than one founder? A lot of thinking is you need to have more than one founder because it makes the business a bit more robust, but that can also blow up a company because people have different motivations. different interests, who owns what of the company. You've got to get all kinds of sorted in the first place. We start going down this journey. It's never as simple, never as straightforward as you think. If you've got a team, do they get on? Do they have complementary skill sets? And VCs invest in ideas as well. You know, they're trying to, they understand that they're taking, or should understand, taking businesses from one stage to another. Private equity, very late stage funding, is different. You've got to establish, you know, if you're in the retail business or something, you want to grow at the next stage. You do not like to become a, you know, a fisheries business, like or a retail business, unless a merger acquisition kind of story. But an earlier stage business, there's got to be a vision around it. Most people have some with a vision. Some of whom are better articulated than others. There is a bit of a thing about the art of the pitch. We'll talk about that a bit later. The second myth here, so I was like, you may always come back to my notes here. So the second myth here is you should target the largest investor with large track record. So people tend to think, well, I heard that of that venture capital firm. I mean, most people don't know most VCs, but you might have read something about like SoftBank, for instance. So I was saying, sure, we're doing with SoftBank ourselves as well as a business. And it's like the world's the second or third biggest venture capital firm in the world. And everybody hears they back X or Y business, it might be. So everybody wants to go for them. The problem is these big firms get bombarded by opportunities. And in fact, the head of SoftBank US said to us when we first launching the beta version of our product, why do we need you? Because we've got the stuff in the door. And they said, oh, I understand. Like noise cancellation, headphones, said, we need someone to help do the filtering. There's so much stuff that comes in the door. So bear in mind, big name firms get lots of people after money. But lots of people after money in any VC. You can have thousands of business approaching VCs every one deal that eventually gets done. Well, it's a huge kind of funnel coming down. But why go after the best known name when there's so much competition? And in many cases, that's not the best fit for your business. So it might look for it's quite hard to understand from the outset and the outside how something that portrays itself to be doing something may not actually be doing quite what it looks like, or it might not be quite as specific as you might need help with. So often it's better, particularly early stages of businesses, to find venture firms or investors who are in your niche effectively and help them try to do that as well. Sometimes we obviously write the platform, but we try to help that as well because it's not just about the name. It can be helpful. If a major well-known VC backs your business, you may be more likely to succeed. But then all these well-known venture firms backed Sandbank and Free, FGAs. And it went poof. There's one VC we were talking about, we put $500 million into FGA 6 months for it, poof. And you know, down the toilet, well-known VC firm, a complete mistake faced on the team. They thought it was cool because it's playing video games, or it's kind of like, you know, asking for money. They maybe should have kind of worked something else out. So, so there are thousands. I mean, we think there's about somewhere between 25 and 35,000 VC and P firms in the world. We track 7,000 of them on the platform. It's actually about getting the right kind of fit, much more than just a well-known name. They can also look at what we call conflicts of interest. So if you often see, very confusing on entrepreneur, you see on a not websites, VCs terrible, but if you see a better one, they might see their portfolios, who their companies they've invested into are. And you might say, oh, that looks like my business. So I should go for something very similar to me that I should go after them because they back something like me. But often they're not allowed or can't back too many very, very similar businesses. They'll do something with the sector. Let's say we back biotech, or we back nanotech, or we back quantum computing, or it might be, or AI. But they can't back too many businesses that are too similar. So if you already see something very similar to you, they're actually less likely to back you, which sounds a bit anti-intuitive. And if you're with a very large VC, you're not going to get the same love as you might get with a small one sometimes. You know, it's like many things in business, it's kind of horses for courses. So even if you're lucky and raise money for well-known name, it's fantastic, but it's kind of sometimes better actually looking at the mid-tier of firms, might be sort of where we do the matching, like halfway down the matches, rather than the best known names. They may not be household names to you, but they might have they got tens of billions that go after them, but actually might be $100 million fund, might be more relevant for your firm. Local investors, so it's often good, and it's difficult in a place like Bermuda to get much VC money, effectively, with our angels obviously here as well. Great to have people understand your market. Obviously, you can explain stuff then as well. Depends how important their value add is in understanding your market. I had a very interesting question. I was posed back to you. So I was in Mumbai a while back, and a VC said to me, asked us about our business, so who backed you in your local market where you're from. You know, you've got investors where you're from. It's kind of important kind of question. And so why is it important? Why do you think that might be important?
Got the local connection that could seem more authentic, I guess.
Partly.
No, I think that it would have something to do with credibility.
Correct. That's
Yeah.
there's a significance effectively. But he did basically, it was kind of a difficult one because he said if you don't raise money from where you're from, even if you've got some globally scalable business, most Bermudian business might want to go elsewhere internationally to get to the next stage. It's a bit funny, but it's very difficult at the same time because it might be you can't find local backer because what you're doing is so different to what there is local. There isn't any kind of background in industry where you're from or something. So it's kind of, so you're going to go, actually it's quite, you'd have to explain why not, but it's quite important if you're going to try and scale your business out of Bermuda, to at least try so you can get some related, because there is a coming people can ask about, yeah, who knew you? It's already incredibly networked from you. That can be good or bad. I lived in Australia for a period, so it's quite similar in a sense. And it's kind of good in a way, because we've got like really great backers who are local. When we first started out, actually, down there. A bit of a journey with business. But we had local business, like over the who's who, because I'd done business, I was in banking with lots of these people and got to know them. And then they said, what are you doing next? And I said, what's doing next? They then decided to back me going for an extra person, secondly for the business proposition. That's very helpful, but it's kind of like, you can also find people turn you down, and it gets very hard because people say, why didn't people back you from Lakers? Just bear that in mind, because it's kind of important in the background of business. Now this is a double-edged sword also. Raising a small round is indicative of success. In a place like Bermuda, it's slightly nuanced. So I'd say it's always good to try and raise some money because it proves you raised some money from somebody. You go through that kind of process. Bear in mind the frogs thing again. No frogs in that picture now. Lizards or anything else. I just tell people that, you know, we had lizards. Something like, it looked like a lizard one stage. That must be Mike's mother-in-law, but no. But ran away. Both circumstances. It is useful to raise money to prove you've got a track record of raising money. The important thing is, though, kind of again, the dating idea, who you get into bed with, because who that investor is can make a massive difference to you later. Because if you get the wrong investor, they could absolutely screw up your business. So we've got like 40-something shareholders in our business. We go on pretty well with almost all of them. The older one occasionally raises some kind of question. So it takes time to manage people, and you don't want to fall out with investors. The investor management business, the investor relations, very time consuming and very demanding. If you get somebody in who can either persuade, I met an entrepreneur here who had an offer for money here. And the problem tends to be in small markets who make funny deals sometimes because they know they can, they're with it. But if an investor does too funny a deal with you, taking too much of an equity stake, or doing a fiddly deal where they want to kind of have some lean or some hold on to your business in some kind of way, it can mess you up later. Because then people sort of turn around and say, put you off there. It can put this, so it can put you off, can put other investors off, or they're not getting on with other investors, that kind of stuff. So you've got to be very kind of careful of that. You've got to get the right investors who you have the right kind of relationship with, who the right kind of deal on shore, and Ignite fantastic helping make sure you structure things correctly so that doesn't happen, hopefully. But the problem, what we're saying here is a bit of a subtlety here, but is that you always need to raise more than the other thing. So I said before, you may want to raise a bit less to show you're hitting various milestones. It's like building as well. Coming to the building here, and it's taking longer to finish the fit out here. Everything costs more. Everything takes longer. It's sure like how long it takes to build businesses. You know, you've got to understand that when you raise money, actually in a way you have to over-ask. So within reason, you have to have a reason for it. It has to add up, stack up. But you've got to, it's a funny balance of how much you're asking for. So make sure you ask for enough, not too little, maybe slightly more than. Show you've got financial acumen is very important. It's very important to show that you understand financials, or if you don't, somebody in your team does. Because it's very important to understand how people are going to ask you what you're going to spend the money on. And you have to be able to explain that to people, to investors.
Simon, is there a magic number?
No magic number. It's
So
type
what
of
I'm saying is, so for example, you know, one of the projects that I was doing, you know, we said between 40 and 50, but you know, as being that's the target at the moment, but like you said, you always ask for that cushion, right? So in actual fact, I should be maybe asking for 60 or 70.
Well, so what you do have to think is what is realistic.
Yeah,
So what do investors in my business look to invest? What's the typical amount they invest? So angels, they might be typically investing $20,000 or $50,000 each
right,
into various businesses. If you're on 100,000, just out the ballpark. If you're with VCs, again, there might be, when you actually then get those matches, you should then do some due diligence, look at who they might be. And it might be they say, look, we invest in, we put in between $2 to $5 million if they're that clear what they do. May not be that clear. So if you ask for 10, either they have to be part of a syndicate, part of multiple people who go together,
right,
or not. The other thing is how do you get back to the returns you get? Because they want to get returns. If you ask them too much up front, the valuation is too high up front, the maths will never work for them to get an exit at a high enough valuation. One of the problems in current financial markets is that high interest rates, how do we calculate valuations? It's how cash flows. They're putting valuation companies down. So the time when it costs more to do stuff, we need to raise more to do stuff, valuations are lower, or definitely exit sale valuations are lower. So how do you get that return in between? So if you ask too much up front, you're never going to get a return down the back end. Therefore, it's not going to stack up maths wise.
right.
So it's a bit of a balance. Maybe you have to break it down into different portions or something.
Phases or something like that.
Most venture-backed businesses have multiple series of investments.
Yeah.
We've had 2 or 3 rounds already ourselves.
Yeah.
It's kind of, you have multiple times which investors come in. It's different investors. Sometimes also the old guys, old investors come in and top up and put in their following rounds, it's called. And sometimes they can't put any more money. They therefore get what's called diluted. They have less stake in the business as new investors come in. So it's also who's right at that kind of stage, and also different markets. So in the US, people have high valuations, they have high exit expectations, and they want to grow much faster, much more ambitious. In the UK, I was in the UK a few weeks ago, people are quite kind of cynical and quite, they want lower valuations, lower exit opportunities. They don't market your operation also in terms of how what aspirations are. But so raising foreign can be helpful, but you don't want to underraise. The worst thing possible is when a business raises some money, the expectations of investors, they raise too little money. And the time of inflation is a time when that's really a problem. We had a venture capitalist panel we did in Boston. We say he tells all his firms he backs to raise more money. Because cash is king. But it's not always easy to raise money. And also things cost more to do. Servers cost more, office space costs more, salaries cost more, everything costs more than it did a year or 2 ago. And that's a different environment was a couple of years ago when that was fairly flat. I'm a bit mindful of time. Myth 4, you need to show, this relates to what's important, you need to show investors a realistic trajectory of your business. So understand that this is some data and research again in the Washington area, the circumstance in the US. We're global, but we operate in the US, you can see, but often some huge misunderstanding entrepreneurs have raising money. You hear that venture capital firms make 3 or 5 times their return when they sell a business. It's a famous 33% internal rate of return, that kind of thing. And it's like 3 to 5 times in many cases, it times money. So they bought into that business $1 million. Okay, simplify the numbers because we do have what's called dilution, making your equity stake lower. But they got out 5 times that or something. You hear that story. Therefore, that's what you think you should be telling them. If you get now $1 million, will exit 5, you make 5 times your money. Just simplistic version. That's not how it works, because that's what they can do on average. And because, as the short I discussed before, 8 out of 10 businesses go bust or go nowhere, or 9 out of 10 cases of venture capitals, they still went. Amazingly, always smart people are making these great decisions. They're making terrible decisions most of the time, but most of them go wrong. It's actually really interesting because even still with all this, wherefore they get wrong. FTX is a classic example, but it went wrong a different way. But there's all kind of reasons these things don't work. But you need to show you're going to actually do far better, because when they get an average of 3 or 5 times their money, when they get that multiple, that's because most of them have gone wrong, and if 1 or 2 of them, they've got a home run. 20 times returns, 30 something. So you need to look at your business and go, if I'm going to try to raise money from venture in particular, certain angels, is that possible? So we had a fascinating meeting for our business future. We met with a venture capital, and we liked what we do, one of the top VCs in America. And looking at investing in our business side, and the guys that found the chairman, it's a very unusual play, said, I won't give you the numbers exactly, but said, you're onto something far bigger than you think you're onto if you do it in these kind of ways. But we're not going to back you with your current expectation. That we thought the current expectation was a little bit toppy because being in the UK, a little bit cynical about, we're here and we want to be there. And so, to get to there's lots of things that have to happen. And we've done all the market analysis and all this kind of stuff. And he goes, actually, we think we'd be 10 times the size. But, and we're only going to invest if you're going to be 10 times the size. Go back and look at your model again. So one of my colleagues, beavering away, looking at the model, is it justifiable? And because one of the colleagues in this firm, that's Goldman Sachs guy, will only back business A at that kind of scale, but B, he's cynical about data businesses being able to have that kind of scale, so you have to kind of prove it backwards to him, so we've got to do all the numbers over again. So reworking the whole bloody model, so you can act as VC, and show them, and it's got to stack up and make sense some kind of way. If they back us, this is the trajectory we want to go on, and how does that stack up? So they're looking for this kind of weird combination of VCs of financial stability or acumen, understanding, on the other hand, huge vision. Now, the vision in America has to be huge in most cases, particularly in major like New York or Bay Area. Other VCs still looking for a great degree of vision. So it's kind of how do you balance that? So just bear that in mind when you build a profile like us, when you're putting a deck together, you've got to kind of balance that. And don't be crazy. Because if it's crazy and unjustifiable, then they won't back it. Because or they'll ask you to explain how that's possible, why you with them together can make it that journey effectively. It's a very weird, sort of almost contradictory set of rules effectively, and explain how you can scale with that. Myth 5, only VCs are interested in unicorns, interested by unicorns. So unicorns, presumably these are like billion-dollar companies, or decacorns, $10 billion companies. That's changed a bit because valuation's gone down a bit, and the VC market's in a bit of flux. But it depends where you go, what business you're in. So there are a lot of venture capital priority looking for more moderate returns. So, and often that's by location as much as by sector. So we found in Boston, we work there, that we had a quote from a VC. VC's looking for horses, not unicorns. In other words, they wanted to have several $100 million valuations exit at sale, but they weren't expecting multi-billion because Boston-based businesses, with a few exceptions, don't tend to get as big, and the returns and expectations of Boston-based investors is a bit more tame. Like the UK, they are looking for some pieces of $1 billion businesses, but there'll be many looking for $200 or $300 million exits. And in a place like Bermuda, if you get a $50 million exit, it's a fantastic return. So you have to kind of look at, in my market with what I'm doing, actually it might be more realistic, and you might do that with then recalibrate on our product, but on our system, we also recalibrate generally who you might be looking to talk to. Because I say that VC in New York and the Bay Area ain't interested unless you're going to be really huge. So you have to justify that. And if it's not going to be them, somebody else. So that's why it's a kissing frogs. Don't talk to the wrong people who've got the wrong expectation management there. So the next one, VCs invest in people like themselves. This is really interesting stuff at a place like Bermuda. So we did quite a lot of research around this with this diversity field we've added in the system. Basically, VC has been a very sort of, one of our advisory board teachers venture at Harvard Business School. He used to 80% of venture capitalists in America he taught, or it's more like 40% now. It's huge dominance of huge narrowness effectively in where those backgrounds as people are from. And most of the VCs have historically been engineers or management consultants or bankers, depending on which markets they've played in. Not always operators. So, Sean and I was talking before about one of the problems a lot of people, new people to VC actually, is that even though some of them from more diverse backgrounds, they don't always have experience in running businesses or understanding what happens in downturns, that kind of stuff, because of their background. So actually, but most research is showing that VCs tend to invest in people like themselves. There's a kind of a Me Too, in the old-fashioned Me Too sense of comfort when you do business with somebody you relate to. I mean, Sean and I from the case, relate to each other, that kind of way. There's obvious ways people relate to each other. That kind of makes sense to an extent. but you often have to go out of your comfort zone. There was a Harvard Business Review case that talked about how VCs of Indian heritage in the Bay Area, in San Francisco area, tended to invest in Indian entrepreneurs who come to the Bay Area, India, or and they got lower returns, lower success rates than when they invest other people who didn't make them. And there are all kind of cultural reasons why, in terms of people not questioning certain things or groupthink that effectively occur. Again, you get cliches that Indian entrepreneurs don't necessarily depend on VCs, because all kind of different things, caste system, different backgrounds, cities people are from. It's not as simple as Indian. Obviously, you know, every community is far more diversity within a community than most people externally think. But basically, what these people at our business schools show is that diversity, I say, is not actually useful, but there are the reasons you work with diversity in many cases because people understand the market. So you understand the Bermuda market if there's an investor externally. They wouldn't necessarily understand that, and that's something you bring to bear. So that's a kind of diversity. But there's also the issue of them understanding it's a continuous education process with the venture community is not just sort of woke sort of virtue signaling, especially how they make investments, like social impact type stuff, etc. But actually, that having diversity of teams, having diversity of background, diversity of origin of businesses gets better returns. There's a lot of data now showing that, not for its own sake, but actually that if you speak to people who don't come from the same background, you're more likely, and so in your teams also how you build your businesses. If you can build complementary skill sets and kind of backgrounds, that gets better returns. And that's increasingly occurring in the venture market. It's still a long way to go in venture. One of the things, again, as a platform we try to do is fast track diverse or regional entrepreneurs in various ways, which is relevant to folks here, but also understand that as a platform, you can be more agnostic. You meet somebody in a meetup and stuff, it's quite intimidating. Some people's cultural backgrounds don't make it as easy. There's a lot of funny dynamics in kind of meetup. I mean, people go back to meetups again. That didn't happen during the pandemic, particularly. But if you go to an event in London, you're going to meet London-centric people type of stuff. But nobody's going to come from Manchester or Liverpool, those kind of places. You're going to miss out on those kind of opportunities. And so it works the same in the US, etc. And you tend to gravitate towards kind of people you relate to and stuff. It's kind of hard to navigate that stuff. It doesn't suit everybody. So it's very important to try and put those kind of businesses forward, and you have to kind of keep on trying that. But don't think it's because somebody's not from your background. If they're not from your background, actually adds complementarity to you as opposed to otherwise. But do a bit of homework on who they are before talking to them. If you think that might be an issue, explain why what you bring to bear is different to the skills that they have, yet they can bring something to bear at the same time. Investor-only entry comes as profitable. This is a late stage thing. So if you're in a late stage business, not so relevant here generally, but if you're in Rubis or something, you want to do a management buyout or something, the investors will be looking at, are you profitable? If not, why not? How can they make you more profitable? Investors tend to understand that newer businesses aren't usually profitable. There are some models with new businesses that can generate profits very quickly. Invariably, most businesses, tech businesses, burn up a lot of capital up front. And that was with the J curve. They spend money and they lose money before they make money. And it's a little bit hard at the moment because a lot of VCs are trying to go more towards revenue, more towards proving you've got sales, which means you've got more of a proven product, or more towards profitability. I'd argue that's a bit of a mistake, depending on what stage they're at and where their criteria are. If they say an early stage investor, that's a bit of a mistake because they are expecting those business profile they're not going to have. And actually, if you try to reach profitability, there's always a trade-off. If you become profitable earlier, does that mean you're not going to grow as fast? If you're not going to grow as fast, you're never going to get the return the VC wants, because VC is about returns. So there's a debate to be had in many cases with VCs. That's a bit of a moving story.
What about pre-revenue?
Pre-revenue depends upon the VC. Some VCs are very happy with it and say, so let's get in criteria. So we had a question on our system originally, we changed it last year, that asked entrepreneurs if they were pre-revenue or no revenue. And no revenue, people think is a negative kind of thing. Pre-revenue is obviously a term that's used where you don't yet have revenue because you're growing something that's not yet hit the market. That kind of defines the stage of the business. There are investors who would do that. In the current markets, move slightly more towards revenue. There's a lot of investors talking about revenue, but actually reality, whether they can expect that at the stage they get into, varies. But people move more towards revenue and more towards profitability in the last year as things have got tougher. Again, one could argue that's a bit silly because if you go too much to the wrong metric, it's not going to be about growth. I think what investors are often looking for with the revenue question, depends on what you're in. If you're in biotech, or like you're building ARM Holdings, you know, that business designing chips, you'd have no revenue for a long time because you're looking at big chunky numbers when you actually do try and get some data. And you look at biotech companies that's stuffing around trying to make something work with no customers. And then the customer, it's like then they're either going to sell to big pharmaceutical companies who are going to make those customers for them, distribute for them, or they're going to have to hit, or they're going to be hitting a market that will potentially be worth that amount, but there's no revenue because you can't get any revenue into trial of drugs and stuff. So some industries naturally are never going to have revenue. Tech is a mixed bag, but it depends kind of why. I think what investors often look for is not necessarily a lot of revenue, but can you prove product market fit in some kind of way? Is there are individual people who are not your mates willing to pay for your product? And what feedback you're getting from that? And a little bit of a balance. We've had debates nowadays about do we focus on revenue or growth, because there's a freemium service with freemium. The premium costs are $20 a month usually if you're on the paid version, but we've played around back and forth what we do with the free version. And there's debate about it because you can build large numbers of people. One of our shareholders will build the large numbers because it proves stuff with large numbers, but actually have a different relationship with people with large numbers. They don't have skin in the game buying paid something. It's amazing how demanding. I found this recently. You made $20 a month, how demanding people can be. It's extraordinary. It's kind of, you know, you think, gosh, you know, it's such a low price point, people will still be demanding. So it's kind of the different relationship with customers. And you get the kind of feedback from the customers, therefore they're paying. Depends what kind of price points are and stuff, but it's really kind of proof of is somebody independent prepared to pay this.
So do you have a pre-revenue type question as part of your thing now?
Yeah. So if you're an entrepreneur, you put in revenue, you put in the last years or various years, like financial, basically various summaries, financials in revenue, profitability, etc. That slots you down different paths, automatically. It's part of the algorithms because different VCs look at different criteria. The VC says, I'm only looking for post-revenue businesses, which implies a later stage business that will slot you down the path. Having said that, we have also kind of made it a little rubbery because you don't want to miss out on things. So we have hot, warm, cool. There'll be a lot of cool matches sometimes for business. Some of the VCs will look at what we call cool matches, which are less of a match, but there's something that sticks out that's really interesting to them. That is a criteria that's really strong, teams really strong, but they actually say they want post-revenue businesses, but actually it's pre-revenue. There's a bit of rubberiness around it sometimes, but people talk a lot about, focus about revenue.
Right. I have to jump in.
Sorry.
Very much.
If you want to leave your details, so I can drop you a line about what we do.
Yeah.
With the car or something. And then investors turning you down means there's something wrong with your business. Thank you. This is a thing which is kind of interesting. So it's a point on entrepreneurs that if somebody's turning you down, does it mean your business is so good? There's two answers to that. One of which, well, several answers. First of all, VCs get it wrong half the time, which is what the FDA's example. And each VC is individual, and there are thousands of them out there. It's like dating. So just because somebody doesn't like you on the date doesn't mean somebody else won't like you. You know, it's just curious, you know, here for our anniversary. You know, person I married her, you like, so I am here, sometimes we didn't, you know, it's kind of it's a chemistry thing, it's kind of, you sometimes think to yourself, that's interesting, you know, some people over the years, like, you know, work and why didn't work, and why didn't work with that person or that person, it's kind of a curious thing. So, it's a bit similar in a sense, a lot of personal chemistry of this. Now, there's a quote here that DoorDash, which was this successful IPO in 21, I was living here at the time, when DoorDash listed, Alfred Lin, who's the guy who lost $500 in FTX, turned down Sequoia Capital in California. Major VC, great VC, it's a great VC. It's back to amazing. This is back DoorDash, which is door delivery. Yeah,
Yeah.
Nobody had it here, but it's kind of door delivery. But it's kind of this massive business. It has become very successful. Lots of competitors are out there, but it's become successful. DoorDash approached him individually at least 6 times. He rejected them. They come along, you know, they introduced him, they sent him the deck, you know, the press presentation. He turned them down at least 6 times before he eventually accepted them. And even if they then accept to talk to you, You then got to go through all the hurdles, try to get the deal done. We don't do the deal on the platform, not a crowdfund or something. But even if you meet your match and even get through to your match, it's never an easy game in the first place. Then you've actually got to do the deal. It's needle and these things, so it's very difficult to get this kind of money. You hear all these stories, it's easy. I was at a conference in Bangkok in the summer, AI Tech conference, and there was what's an LP, like an investor. This is a VC. Now VCs, what's got LPs, VCs have to raise money what's got LPs, so the people who fund them, the family offices or the pension funds fund them. This guy was a sort of sole GP. You don't come across that often. He runs his own VC, but it's a one-man band, basically. Cambodia, Southeast Asia. He'd worked in various business, an idea of several VC funds, He said on this panel, he was turned down because they have to raise money themselves in pension funds. He was turned down 60 times, 60, not 60 times, 10 times, by one LP before there's a yes. 60 times. So one of the things that VCs are looking for is resilience and persistence. But there's a balance between being resilient, persistent versus pissing people off. So, and it's funny because I mean I'm very persistent. I've always been. I used to run business development for a bank. I've always had business development type. I've got a banking background. There's a business development area, and we are regularly in contact with VCs, that all kind of things. And we've got people on the platform very old. I mean, it's a kind of weird balance because VCs are a little bit superior in some sense. We got the money. It's like to shorten it, the Bumble analogy. The Bumble is different to Tinder because the women have control. And in the sense, in our platform, VCs have more control than entrepreneurs because the way we've calibrated, the VCs don't want too much to be bothered too much. They want to be able to mosey and look when they feel comfortable with it, which means you get less contact sometimes than people want, and it's a bit of frustration on entrepreneurs. And you have to think how to manage that, how to balance that. There's all kind of reasons why that could be the case. But if you hassle somebody too often, you can obviously annoy them. The other thing is also that sometimes there's timing, said before. So just because a VC isn't going to back you now does not mean they're not going to back you in the future. That's because your business is going to change. There are also people on the platform to make sure they update their profile regularly because it respins the algorithms. So we're looking at various ways that should automate that better at the moment. So that if data changes on the VC side or the entrepreneur side, you can respin algorithms, make it static, and that means that you can end up with e-matches. Also, let's say a VC, like you're trying to raise money, your VCs have to raise, as I explained before. Let's say VC's deployed all the cash, or they've raised their money, or they're helping existing portfolio companies. It's not the right time. It's in the UK, or it's in the UK VC markets are very stuffed up at the moment. And one of the problems is not there's not good entrepreneurial business. There's more entrepreneurial business than ever seeking money than ever. For all kind of reasons. But the problem of VCs have in the UK is they've got problem portfolio companies. You know all the maelstrom of all the economic nonsense going on, wars, inflation, all this kind of stuff. It's made a lot of their companies they've already invested into problematic that they didn't anticipate. They spend lots of their time helping problem companies they've already invested into. So one particular VC, the major VC in the UK, told us that, look, 80% of my time is helping my portfolio. I'm just not doing anything else than that because they've already put money in there. Some of it's good money after bad, they have to move on. The problem they get into there is they're not building new portfolio companies for new investments. They could often get for better returns and better valuations, and they're missing out on that because their mind's on the bad investments. They've got their own opportunity costs, but that could be you're just coming at the wrong time for them, not you're wrong for them, the wrong time for them. A lot of it's timing, it's all kind of factors how it works.
I mean, I know for my profile, I was waiting for myself to register it, but now that I'm doing it this week, I'm like, hey, I can add more stuff, and that can hopefully change up the algorithm as well.
Keep on updating the profile because that always spins up, but also it's accurate. If a VC comes and sees a partial profile, they may move on because this way it does wait so it's kind of it's not looking as complete as others. Now itself shows, you know, you can show less or more information for those profile settings now, but it's better to have the best foot forward.
So I'm just aware of your time.
Yeah.
And we've got three more.
Two more.
Okay.
Then I'll wait to the video. You can watch that another time. 2 more minutes. Okay. I'll try. Is that?
Yeah, of course. I just wanted to get.
I've got something else, but I'm trying to get this across because pitching events, you guys know those pitching events, we're a little bit cynical about pitching events, isn't it? It's part of the ecosystem, it's part of the way things are done. Bear in mind a few things, pitching events. They're part of the process for many people. They're a beauty for people. So it's a dating game. You know, it's like the you know, it's like you're watching, you know, millionaire matchmaker type thing, you know, all the blokes go off, like, you know, something sort of model or something, it always happens. And actually a very funny story from there's a very funny story that this VC something I know about that kind of gravity right now, bit of an oldie story, but a funny story about a well-known person, but that kind of thing. But it's like people going to, you know, maybe frightened, but others gravitate towards, you know, it's very superficial in many cases. And the superficiality really often comes across, or people are very good pitchers. So I was a pitcher the other week in Philadelphia at the big VC conference, and there's one woman she was just a great pitcher. She raised a ton of money off like a Shark Tank type operation. Now they don't always cut checks afterwards and promised it, but she was just very, very good and very trained. So she was good. It suited her. I was a little cynical about some aspects of her business, frankly, but she was a great pitcher. One or two other people presenting weren't great pitchers. Their business might be more interesting. So it suits people who are good presenting, and also it depends who you're pitching to. So if you're pitching to an audience of angel investors, it's only really worth doing if you know they're going to be, not only have checks out, you may or will write, but also they are potentially the right match for you. So if they're going to be in the wrong sector, so don't waste your time, unless they might be able to refer you something. But basically, somebody refers you, anybody who refers, so it can be great, but so why didn't that person get it, kind of stuff. The other problem is you give away a lot and spend a lot of time. It's very time pitching.
Is there a way for someone like me who is awful at pitching to actually
You're awful at pitching. God help us. Help us.
I'm very
Well,
Somebody who doesn't think they're very good at pitching, but
Accelerators like you know, partners
Yeah.
who work with, like, so we go Ignite, want to get more Ignite people on the platform. That's what Ignite is for. I mean, that's the soft stuff, and we can try and help with some of that on the platform, try and do more educational stuff on the platform. But it's just, I mean, you can get better at it, but not everybody likes it. You know, not everybody's good at it. And the problem is often the team. Sometimes you'll find somebody who's better pitcher, but not the person running the business will present or something, and that also sends alarm bells with investors. You've got to be able to, as an entrepreneur, you've got to be able to tell your story. You've got to be articulate in some kind of way. Some people are very articulate, so it's not. It's which area it is, but most businesses you have to articulate a message, and that's kind of what you're looking for. But if you go into that space, there are all kind of questions people are going to ask you, and are you ready for those questions or able to those questions? And people have kind of seen enough of this kind of stuff. It's a very tricky game. But I won't say don't do it. But we've raised money from 43 different investors, and not a single one came from pitch event. I must present it. I'm kind of good presenter for reason. I'm not a great pitcher, I'm more of a presenter. No, it's different style. Pitching is more a presenter than a pitcher. It's also different. But even I, you know, we presented a few pitches. We never raised a single bean at those things. We were better at identifying people through platforms, through individual networks, etc., and that kind of stuff. And so what we're doing as a platform is get you in front of some of the people potentially, and then you can try and reach out to them. So I'm better at emailing somebody who comes. So we've used our own platform to identify our own funders. So we had a bunch of potential matches. We then shortlist a bunch, then we then reached out to those shortlist. And that kind of almost CRM type approach, and then set up meetings, one-to-one meetings that come from that. They've been much more successful than some of the pitches, but it depends. It also very much about what you're doing. So if you're doing something very cool, very trendy, and very in, and you look right, and someone's doing it was a fashion business, sustainable fashion. It was like she checked every bloody button, that thing, and she was a great presenter, so a great pitcher. So you know, but the other two walked away, you know, with anything.
Okay.
So it's very depressing also. It takes so much time. You know, it's so much. You've got to put the deck together. You've got to train for it. You've got to be there. So it takes probably 10 hours, 15 hours, 20 hours just to do one pitch when you work it out. I mean, activity hours.
So I will tell you that they have AI out right now.
So I wasn't
to do a lot of presentations.
And then I
it's-
end up sounding like everyone else pitching.
No,
Oh,
it
no.
works,
Okay,
it works, trust me.
So I was moving to pace through my slides and I wasn't
Yeah.
clicking this, that's what's going on there, sorry. Shane. Anyway, there's a couple other thoughts in here. We've got myth 11 is about, you know, the more investors we contact, the more likely we are to get funding. So I was clicking this fast enough. Well, I was chatting away with you folks. Again, that's a focus thing. So bear in mind, this is the last myth here, but we've got a sort of flyer here with just read the flyer, the 1 page flyer, the very quickly, just to summarize the myths. But bear in mind that your time is your money. So there's an opportunity cost. So the more people you try to reach out to, the more time you spend doing it, the less likely you are to raise the money. So one thing we try to do as a platform is try to narrow people down. And actually, it's always a bit of a balance because you've got to have like 100 or 50 or something to try and go after to get down to 1 or 2 out of those numbers. But you don't want to go up like 500. People often try and reach out to so many folks that actually wrong time where it might be more you're spending your time doing. Try to focus as much as possible for those most likely. It's very hard. And it is a huge numbers game, but try to reduce those numbers down from being huge to being sizable.